Keppel wants us to focus on a massive $200 billion target, but the real story is buried in over 14,000 residential units in China. When a company relabels its problems as transitional noise, the retail investor is the one left holding the bag. Today, we are tearing down the asset-light narrative to find out if this dividend is actually safe. You can refer to the Q1 report in Substack as a reference, as I walk you through my analysis of Keppel's deck. The opening picture shows a deep divergence between what management highlights and what the bottom line actually reports. Overall net profit is down, driven heavily by massive fair value losses in the legacy assets they are trying to leave behind. Yet the spotlight is firmly pointed at a 13% rise in asset management fees. For investors relying on dividends for their retirement payouts, this gap between accounting spin and operational reality is highly material. That difference ultimately determines whether your retirement income is stable or exposed to sudden compression. We need to strip away the asset-light narrative and evaluate their actual capacity to protect your capital. The transformation from a heavy industrial builder to an asset-light global manager is the core management narrative right now. It is also the most forensically loaded claim in the entire results pack. Performance is presented through the construct of the new company, a ring-fence view that conveniently excludes the non-core portfolio tagged for divestment and discontinued operations. Under this isolated metric, net profit appears only slightly lower year over year. The framing is deliberate. By drawing a line around the parts of the business that are working and relabeling everything else as transitional noise, management creates a reality where the transformation is already a proven success. But we need to look at what you actually own. Retail investors own the entire company, not just a curated, high-performing subset. You cannot opt out of the legacy drag. Group-level results reveal a much harsher reality, with overall net profit declining in the first quarter of 2026, driven by fair value losses and weaker monetization from those older assets. Corporate transition costs cannot be erased by reclassification. They are real cash leaving the building and a real drag on performance. On the positive side, asset management fees did grow 13% to $108 million, supported by $0.4 billion of new funds added in the quarter. The $200 billion target is the centerpiece of their investor relations story. Funds under management represents the gross value of managed assets and committed capital, measured on a leverage basis. The fees collected on these funds represent recurring, rent-like income from institutional capital. The higher this number goes, the larger the fee base becomes. The forensic question here is not whether the asset management business is growing, because it clearly is. The real question is whether this fee income is growing fast enough to offset the profit erosion from the legacy assets while the corporate transition completes. On the current first quarter numbers, the answer is not yet. They have $2 billion of institutional commitments pending finalization, which shows the momentum is real. However, only $385 million of asset monetization has been achieved year to date in 2026, against a $2 to $3 billion full-year target. One quarter in, and they are not even close to pace. The run rate needs to accelerate materially from the second quarter onwards. Cash flows have improved, but the profit drag from legacy assets remains completely unresolved. And these fair value losses are not just a one-off accounting adjustment, they reflect genuine erosion in the carrying value of assets being sold into a difficult market. Presenting a ring-fenced, performing business is not inherently dishonest. It is a legitimate way to show investors what the balance sheet looks like once the transition completes. The central problem is the timeline itself. Management has not committed to a hard completion date for the non-core wind down. For a 50-year-old investor funding their retirement, this ongoing transition demands deep patience while dividends remain fully exposed to legacy risks. Patience is a luxury that not every portfolio can afford, especially when income visibility is clouded. Infrastructure and connectivity remains the group's most resilient pillar by a wide margin. Earnings actually rose year over year, with integrated power showing strong resilience despite a slight first quarter earnings decline due to softening electricity spreads. To be clear, this metric reflects core operating cash generation before financing and accounting adjustments, and softening spreads simply indicate shrinking profit margins in the broader power markets. Management is actively taking mitigation actions to lock in long-term power sales and stabilize this income. They are making serious moves to secure long-term income visibility. The 600 megawatt hydrogen-compatible Sakrakogan plant is fully contracted for 2026 and 2027. In their decarbonization and sustainability segment, more than $700 million of new long-term contracts were secured in the first quarter alone, bringing the total backlog to an impressive $7.6 billion spanning 10 to 15 years. Notable wins include a 20-year Tenga centralized cooling contract and an artificial intelligence-enabled cooling partnership. The book-to-bill ratio of roughly 4 times confirms incredibly strong pipeline conversion, meaning execution discipline is now the critical variable. And here is what that actually means. Management buried Middle East geopolitical risk in a single back-of-deck slide. While claiming limited impact, the disclosures admit a heavy reliance on diversified gas supply, including international liquid natural gas cargoes. Any supply disruption risks rapid and severe margin compression. The most critical omission here is the percentage of unhedged fuel costs. Cost pass-through mechanisms exist, but they operate with a delay. Hope is never a valid hedging strategy when energy markets are this volatile, and retail investors need to understand exactly how much pricing risk they are absorbing. The connectivity division is laser-focused on targeting artificial intelligence-driven demand. They have 25 data center assets sitting in KEPPEL'S DC REIT, plus 14 additional assets owned or developed by the parent company and private funds. The 720 megawatt Melbourne site is under customer engagement, and construction on the 9th Singapore facility begins in mid-2026. However, hyperscale data centers require incredibly heavy upfront capital. Until these assets are stabilized and injected into the REITs or private funds, they aggressively consume balance sheet cash, meaning fee extraction is heavily delayed. The growth is absolutely real, but the dividend translation is deferred. Real estate is the largest drag on this entire corporate transition. Earnings were materially lower year over year due to the absence of valuation and divestment gains seen previously. Looking at their residential land bank of over 31,000 units, China makes up a staggering 46%, representing over 14,000 units. Vietnam makes up 28%, Indonesia 14%, India 11%, and Singapore just 1%. China's structural property downturn creates severe valuation and monetization risks. While some monetization has been reported, these massive China and Vietnam portfolios remain incredibly difficult to exit without taking steep haircuts. Holding this stock today implies indirect, unhedged exposure to Chinese real estate sentiment. Which brings us to the part most investors miss. Management highlights an impressive $200 billion target and rising recurring fees. But critical data like net asset value per share and the current share price, management has left those out entirely. That is a deliberate choice. Think of it like buying a retail shop. You pay for today's cash register, not the promise of future foot traffic. When the share price runs ahead of forensic value, investors are simply paying for hope. Any miss on that $2 to $3 billion monetization target risks immediate valuation compression. When we try to stress test the income sustainability, we hit a wall. We have the 13% growth in asset management fees, which is a clear pass, but earnings for the new ring-fence company are slightly lower. More importantly, the current dividend payout and the yield are simply missing from the presentation. We cannot benchmark this against our minimum yield hurdle of 4.7% because the data has been excluded. A scorecard with this many critical gaps makes it impossible to verify if the income is sustainable or if the risk premium is adequate. The debt health scorecard is completely blank. The gearing ratio, net debt figures, interest coverage ratio, and nearest maturity dates are all missing. These data gaps are not an accident of incomplete reporting. They are a glaring forensic signal in themselves. We expect gearing to stay below 35% and interest coverage to sit comfortably above 4 times. But without the numbers, these thresholds cannot be verified. This lack of transparency forces us to question what the balance sheet actually looks like right now. When a company releases quarterly results without disclosing its dividend, yield, gearing ratio, or interest coverage ratio, it is making a deliberate choice. They are directing your attention toward the metrics moving in the right direction, like fee growth and backlog wins, and steering you away from the metrics that allow an independent assessment of fair pricing and income safety. For an investor running a strict forensic framework, every core filter is blocked by a data wall that management built. The 4.7% yield hurdle cannot be tested, and the debt ceilings cannot be confirmed. To be clear, this is not a reason to dismiss the stock entirely. The operational momentum in infrastructure and asset management is completely genuine. However, a management team confident in its balance sheet has absolutely no reason to omit gearing and interest coverage from a results presentation. The omission itself carries heavy information. Investors buying purely on fee growth momentum are pricing in the entire transformation and paying for it upfront, which is a highly speculative posture, not a forensic one. We are holding this firmly on the watch list until those numbers surface and can be properly stress tested. In this market, the difference between a safe income sanctuary and a devastating yield trap is decided long before the opening bell rings, not after the damage is already done. The red flags are always there, hidden in the omitted data, the delayed timelines, and the structural exposure to foreign real estate downturns. The only question that matters is whether you have the proper forensic framework to read those signals in time to protect your retirement capital before the market forces a brutal repricing on your portfolio. If you want to see these red flags before the market moves against you, my institutional-grade financial cheat sheets give you the full gearing ratios, occupancy gaps, and debt overhangs long before the opening bell. Iggy's elite investors get zero-day access to these completely unvarnished reports, so you stop being the exit liquidity for institutional players and start being the analyst of your own wealth. For $9 a month, less than a kopi and kaya toast set at Raffles Place, you can access the exact tools needed to navigate this market. The link to join is in the description below. Looking ahead, we have three clear paths. The bear scenario is triggered by an energy crunch and a rate spike, leading to severe margin squeeze and lower distributions. The base scenario assumes the $2 to $3 billion monetization target is successfully met, resulting in debt reduction and maintained yields. The bull scenario requires rapid scaling of artificial intelligence data centers, accelerating fee income and triggering special dividends. While past execution proves they have the capability, investors must remember that monetization cash arrives over years, not quarters. Since October 2020, management has announced a staggering $14.8 billion in asset monetization. But the danger zone lies in the long gap between a headline announcement and actual cash realization. Until those proceeds are actively used to reduce debt or are returned directly to shareholders, the headlines remain nothing more than accounting ink. Management's credibility remains intact, but their operational clock runs much slower than a retiree's wallet can afford. Keppel is currently pricing itself like a pure-play asset manager, yet it is asking retail investors to absorb all the volatility of an illiquid property portfolio. The yield question remains wide open, and the massive China drag is still unpriced in the current narrative. The red flags were always there. The 7-day embargo window is running, but you do not have to wait for the market to confirm what the missing data already tells you. Join Iggy's elite investors today using the link in the description to secure your portfolio. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MATS licensed financial advisor before committing funds.